Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead. Okay, welcome back everybody. It's the 8th of June. Lots to discuss, Hugh, today. We've got a hot payrolls report, what all this means for central bank policy over the coming months. And we're going to have a little bit of a talk about the IPOs that are coming to the market. Definitely more interest in how SpaceX and Anthropic and others, potential IPOs, what that might do. So let's start off with the payrolls number that came out of the US last week. And I think when we spoke last week, Hugh, we were talking about this being, well, the market's certainly looking for a Goldilocks payroll release. For those who perhaps aren't less used to financial market terminology and wondering why we talk about nursery rhymes, the idea here is that markets like to see data that is just right, not too cold, indicating the economy could be slipping into recession, but also not too hot, indicating that the economy is actually too hot, and maybe the central banks might have to raise interest rates to slow things down. So Goldilocks is the term used for just right, but it wasn't just right, was it, Hugh? It was actually a little too hot.
It was. So the markets were looking for about 80 to 100,000 jobs to have been added to the US economy over the course of May. And instead, the number that we got was 172,000. So well above what was anticipated, a stronger labour market than we were expecting. And if I just put these numbers into context, over the course of 2025, on average, we had about 20,000 jobs being added to the US economy. So the conversations we were having at that time were all about how you had a strong headline growth figure, you had businesses being willing to invest, but not really willing to hire. And so I think when you look at this data, when you look at how some of the previous months were also revised up as well, really what we're seeing is a labour market which is catching up to the strength of the economy that was implied by other metrics such as the PMIs or such as GDP as well. The only small caveat I'd say with last week's data is that the wage growth numbers were bang in line with expectations. So wages are growing at around 3.5% year over year. So while the overall level of labour demand was really strong, I think the one piece of better news for the Fed when they think about inflation is that wages weren't running away too quickly.
Yeah, and I guess, as you say, the context here is that we know the US economy is being hit by an almighty cost shock, and we should say prospects for a decline in oil prices due to a de-escalation certainly don't look so positive over the weekend. There's been a renewal of tensions between Israel and Iran. So that cost shock's hitting an economy which looks pretty strong. And I think it's worth remembering, Hugh, that you're talking about the number of jobs the US is creating, and that sort of 180,000 wouldn't have been perceived to be a particularly strong number a few years ago when the US economy was seeing mass migration. Of course, it's a very different supply of labour backdrop today because we know there's been a really strong clampdown on migration. So actually, maybe the supply of labour's running out. What's the kind of break-even numbers people talk about now?
Yeah, so if we go back a few years, you would have used to think maybe 200,000 jobs a month would be largely just keeping up with the amount of new supply of workers that were coming to the US. It's pretty hard to do this in real time, but I would think something in the region of 50 to 100,000 jobs at the moment is a signal where you would say, okay, well, that's roughly the new people entering the labour market, and so that's just holding things flat. If you get significantly above 100,000, which is where we are at the moment, that suggests this is a strengthening labour market. So I think you're right. In that context, you start to think forward about the Fed and what they may need to be doing on interest rates if we see this acceleration in the labour market continuing.
Okay, so that was a big piece of information for the Fed. Another big piece of information that's coming this week on Wednesday, which is the inflation data for May. So the consensus is that headline is going to push up to 4.2. Perhaps more worrying core inflation, which has been sticky. I mean, it's been sticky everywhere, hasn't it?
Yeah.
Since the pandemic, but that's still lingering, expected to push up to 2.9%. So probably, that's going to be another really important release for the market because it is the Fed meeting next Wednesday. So not this week, but next week. But importantly, this is the new chair, Kevin Warsh's first meeting. Now, over the weekend, the president has been making quite clear what he thinks the new chair should be voting for in the first meeting. The expression that particularly took my eye is when they raise interest rates, they try and kill success. I don't want to kill success. We should actually lower interest rates. So the president's been quite clear about perhaps what he would be doing in that seat. So there is quite a lot of pressure, isn't there, on the chair and on the committee generally. I mean, this isn't news. We know the Fed has been under tremendous pressure since President Trump took office again. How is the market pricing what the Fed are going to do to end year now with this backdrop of rising inflation, a strong economy, but at the same time, a lot of political pressure?
Yeah, definitely. So the market, as of today, as of Monday, is expecting a faster pace of rate increases than it was last Friday before the labour market report. There's still only around one rate hike priced for the full year. So the markets are expecting that by the time the Fed gets to that December meeting, they will have increased rates by 25 basis points. I think when we look ahead to next week's meeting, we'll get a new dot plot. So this is an aggregate of all of the different members of the Fed and where they see interest rates standing over the coming years. And when they last did this exercise back in March, the median member of the committee, the central member of the committee, was still expecting interest rates to come down this year. There was one cut indicated in the dot. So I think that might be one area where markets are paying attention next week to see whether that will change. And instead, this is now a committee saying, actually, we think we're in a pretty decent place. We can see the upside risk to inflation, and therefore maybe no changes this year become that central expectation. But obviously before that, we have the ECB meeting this week. Karen, what will you be looking out for on Thursday?
Well, I think the ECB are pretty much done in the market's mind that they are going to raise interest rates when they meet. They had inflation last week, which did show we're starting to see those energy price effects. Headline was 3.2 and core was 2.5. I mean, Hugh, you showed a chart in our morning meeting today, which showed that although headline inflation's pushing up, the labour market in Europe is in a totally different situation to the US. And this is why, even though the ECB have promised and are expected to act, I don't think they should be. I really hope this is the sort of warning shot that we see from the ECB and that we don't see any further hikes, because I think, honestly, if we do, then that will lead to an unnecessarily more extensive slowdown in activity than is warranted. And maybe we'll be talking about inflation undershooting next year. So the ECB clearly want to demonstrate that they're awake, that they don't like inflation rising, that they're willing to act. I don't think they should be. Let's hope it's just the one and done. But, you know, this all feeds into this broad market narrative, doesn't it? That we know headline inflation's rising. We know the central banks are under pressure. If they start to raise interest rates, that's going to make the equity market wobble. So that is definitely the key theme. But there is another key theme that's starting to be discussed, and that's the fact we've got some really big names that are going to enter the US equity market. They are going to come for an initial public offering. And we're starting to get a lot more questions about this. And I know, Hugh, you and the fabulous Lily Gilmore in our team has been doing some work on this. Can you talk us through our thoughts on whether this is going to be particularly traumatic for the US equity market to digest?
Definitely. So there are three big companies that we're talking about here: SpaceX, Anthropic, and OpenAI. And all of them seem to be preparing for an IPO at some point this year. SpaceX could well be as early as this week. There's potential for that IPO to go live on Friday. And when you look at the headline numbers that these companies are valued at, they are huge. Anthropic filed its paperwork last week as well, and they've recently raised on a $965 billion valuation. So bearing in mind, this is a company which is going public for the first time, that hasn't been making revenue for that long, and they're valued at close to $1 trillion US. So the questions we've primarily been getting from clients are very fairly to say, well, if you add these $1 trillion companies to the S&P 500, how big might they get? What might that mean in terms of investors having to sell other companies to make space for some of these new issues? But without getting too weedy here, this is where how these indices are put together is really important. Because first of all, there are specific constraints that people like the S&P mandate to say you have to have been making profits for so long before you can be a part of our index. And importantly, you have to have floated a big enough part of the overall value of your company before we'll let you in. So take Anthropic as an example. Even though they're looking at close to $1 trillion valuation, your typical company, when it IPOs, only makes available to the public between 10 to 25% of its shares. So the work that Lily has done showed us that if you assume each of these three companies floats 10% of their shares, those are still going to be very large volumes, but those three companies in entirety would only make up about 0.6% of the S&P 500. So key message number one, take with a pinch of salt the amount of disruption that we're going to see at an index level, because there are many hurdles that these companies will have to jump over, and in particular, a big volume of shares that they have to eventually be happy to give away before they'll really start to become major players at an index level. But I think, Karen, the more important piece of information here is how this is going to fill in some of the gaps that we've been dealing with in terms of just the state of these companies. The large language model providers, so that includes Anthropic and OpenAI, have generally been sat in private markets for the past couple of years. And so while we've been able to scrub the balance sheets of people like Microsoft or Amazon or Apple and see how much they're spending, we haven't been able to do that for the companies in the private market. So I know that's something that I'm looking forward to, and I think it'll allow us to really get into the weeds of how these companies are faring in terms of profitability, in terms of revenue, and also the strength of their balance sheet.
Yeah, I think that's a good point. And maybe let me build on that. So basically, the point you're making, Hugh, is that if we think about the whole AI ecosystem, we've got the producers of the technologies, which are the big hyperscalers, the names like Microsoft. But then you've sort of got the next section bringing all of that technology to the world, to global enterprise and to global consumers, which is your Anthropics, your OpenAIs. But because they've been private, we haven't been able to scrutinize that really important segment, which is telling us the most important piece of information we're trying to find, which is there demand for all of these AI capabilities? And therefore, how should we value everything else down the ecosystem? So it's going to be brilliantly positive that they're coming to market and we're going to get numbers that are scrutinized, that have to be provided to the regulator, rather than us all just trying to listen to podcasts and work out what's going on in these companies. So I think that that's going to be a really important new piece of the puzzle. But I also suspect, Hugh, and I'd like your thoughts on this, we know there's been this circular financing issue. They all kind of own bits of each other, don't they, in this ecosystem? And they've said that this is because we all need each other to bring this amazing technology to the world. So us all investing in each other is absolutely the right thing to do. I kind of think when we consider the market momentum into this, that it's therefore in everyone's interest to continue talking up the AI story in order to make sure these share offerings go very well. So if there was to be any disclosure or any nerves about this, it probably actually isn't a 26 story. It's probably when they're all in and digested and we're scrutinizing the information. Maybe that's next year. Maybe this is actually just a real tailwind for the story to year end. Would you agree, or do you have a different take?
I mean, any IPO can be volatile, and particularly when you're dealing with such large ones that we're talking about here. But so far, the demand signals have been very positive. So SpaceX were reported to have said last week that they already see more subscription for their available shares than what's coming to the market. So certainly they are popular today. But I completely agree with you. But basically what this is going to allow us to do is to stop having to try and track earnings reports through interviews or podcasts, as you say, and piece together, well, 9 months ago they said they were going to be profitable then, and now today they've said now, and really just be able to look at a set of quarterly reports and get into the weeds of the numbers. So that, I think, is going to make tracking that end demand and tracking the route to profitability and the increase in profitability that much more straightforward. And with that, I think more information is always going to be welcome. We don't know what that's going to tell us, but it's certainly going to be helpful in allowing us to make more informed decisions.
Absolutely. More data for the nerds like us, Hugh. We'll be loving that. Okay, so to recap, the US is looking maybe a little bit too hot at the moment. That's going to be important as we digest inflation and then think about the Fed next week. Also, the ECB on the docket and thinking more about these IPOs. But actually, our take is that it's not on our top risks for H2. Coming up this week, if anyone wants to join, I'm going to deep dive on the dollar with Nicholas Wall, who's our currency expert on Wednesday's Market Watch. And then you and I have got a very busy week, haven't we? We're putting together our mid-year outlook, Hugh. And we're going to talk about that, actually, for next week's pod, aren't we?
We are. I'm looking forward to that. Yeah, we're hoping to go live a week today, Monday the 15th. So plenty of bits to be scrubbing over the course of the next few days. We're hoping for no major developments in the global economy that might force a rewrite. But yeah, back next week to talk everyone through that.
Absolutely. Wish us luck. Have a good week.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.